Hello members and welcome to today's Fat Profits Macro webinar. My name is Roger Malik, the host for your webinar today, and I'm pleased to welcome our founder and CEO and also our fund manager, Angus Geddes. Angus, welcome to the macro webinar. How are you today?
Hi Rog, yeah, very well, thank you. Always good to be here on the Thursday webinar.
Yes, there is a lot, as always, to discuss today, but in particular some US debt ceiling issues that's certainly forefront of everyone's mind. So we'll talk about a lot of those points today. But before we get into the discussion, a quick disclaimer: all our presentations, including today's, is general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor. And also past performance is no indicator of future performance. We have a Q&A session in today's webinar, as always. So if you are new to our service, you can ask a question or two towards the end of the webinar about the macro events. And this webinar is all about the big picture, what's moving the markets, and how that can affect your portfolio. Now, having said all that, let's get into it. First thing first, quick look at the markets from last Thursday to this Thursday. What are the changes? So if you notice, the Dow Jones is down close to 2%, the ASX just about 1%, and NASDAQ holding up pretty well, and we'll talk about NASDAQ today as well. FTSE down, China certainly on its way down, and we will talk about China as well today towards the end of the webinar. Now, one of the key things to look at as an investor at this point in the 2023 cycle is a comparison between last year and this year. And if you notice, last year, of course, we entered the bear market, which has now become the third longest bear market in history. You notice 2022, yes, the US markets led the global markets down, NASDAQ taking the biggest hit, 33% down. Versus this year, if you notice, the recovery in some of these markets, including the NASDAQ, the S&P, is not been too bad. And the big question now is whether this is sustainable. Are we into a new bull market, or is this just a little bull run within a longer-term bear market? And we will dive into all of these numbers, but it's good to have a bit of a comparison. You can see the FTSE is really an exception, where last year they were up slightly, but this year also they're up slightly. So they're not really down much compared to the rest of the world. Moving on, let's talk about the big topic today. We'll bring that right up the top before we dive into others. There is a concern now amongst investors about the US debt ceiling deadlock, which is the deadline is the 1st of June. Both parties are trying to come up with a deal. At this point in time, the deal is not there, and the concern is that if it gets too close, the markets will get nervous. And this chart in particular shows in the past when the debt ceiling deadlock was very close to being breached, what happened in history. If you look at 2008, this is basically CDS, which is credit default swaps. And what that really means is the cost of insuring against the US default. That really spiraled in 2008 and went up to very, very high numbers. But then we've had a few more times in 2011 when, they were pretty close to that. You can see the premium really went up, and the VIX, which is the yellow line, the volatility really spiked as well at that point in time. 2013, similar thing happened. The premium went up for insurance. The VIX did follow, but not as much. And if you look at it today, the premium has gone up. And the key thing is the market seems to be pretty complacent. The volatility index has not really gone up much, except probably the last day or two. So on that note, Angus, I'd like to bring your thoughts into picture today. Firstly, what are your thoughts on the debt ceiling issue? Is there a small chance that there might not be a deal? And what's the likelihood of a deal going through? Your thoughts, please.
So look, my view, Roger, is that the markets are being complacent. with respect to the debt ceiling, I would have thought there would have been a bigger reaction, not just with the equity indices, the major Wall Street indices, but also with the VIX. The volatility index is still pretty low, at 20. And whilst I think the US government will get there with the Republicans and sort out a deal to raise the debt ceiling, the risk of a default happening because they can't reach an agreement is not zero. It's not zero. Look, I think we're in for some. I think we're in for some turbulence as we sort of get closer to the first week in June when the US government starts running out of money. I think volatility is going to rise. Of course, they reach a deal at the 11th hour. Chances are that the S&P 500 will retest that 4,200 resistance level and break out on the top side. But before that happens, we need a resolution on the debt ceiling.
Yeah, interesting, because even if the Republicans get what they want, which is cutting down on the spending, that's not necessarily very good for the markets as well, because that's not going to help growth in the economy. So there seems to be not too much focus on that. But look, time will tell. But the S&P 500, you're right. So at the moment, we're in that trading range, as you've indicated there. So what are your thoughts? 4,200 seems to be quite a bit of resistance there. What are your thoughts on the market action?
Look, I think it's just going to be choppy heading into next week. And, the closer we get without a solution, the more the markets are going to react, which, puts more of the politicians under pressure. I have been a bit surprised that we haven't seen a bigger reaction. And maybe we're beginning to see that coming through now. Although, when stocks like Nvidia come out and shed the lights out on the earnings front and rally 27% in the aftermarket, it's kind of obscuring what's going on beneath the surface with a lot of other companies, which, a lot of other stocks which have been under pressure.
Yeah, look, that's something that we can talk about now, because this is a recent survey from global fund managers from Bank of America, and this seems to be the common trend at the moment, where they're certainly long for the big tech companies, so they're getting the bid, and it seems to be the flavor of this year so far. And a lot of them are short on the US banks, they're short on the US dollar, and now even China is not being the flavor anymore. You can see the difference between April and May. The dark blue line is May and the light blue is April. So they're starting to move away from China at the moment. Big tech, let's talk about that quickly, Angus, because Apple, Microsoft, Nvidia, as you mentioned, their PE ratios, price to earnings, are through the roof at the moment, but the market seems to not care. There still continues to pile on. And yes, Nvidia have reported their earnings after the market closed and seems to be very strong. And there seems to be positive features for tonight for the NASDAQ. What are your thoughts on these big tech companies? Do you like them at the moment? Would you buy them?
No, I wouldn't. I would not. I think, this is the most crowded trade we've seen in the market since, probably since the early 1990s, and perhaps, even the 70s with the Nifty 50. This is 5 companies which now account for 25% plus of the S&P 500. And of course, these companies all, as you mentioned before, they've all got really expensive price earning multiples. Apple well north of 30 times, Microsoft well north of 30 times, Nvidia at 62 times. So, really expensive. I think AI is real. I think it's going to have major, profound impact on this world that we live in. It's going to, everything we're hearing about AI, I believe, but it's not going to happen tomorrow. It's not going to happen probably in the next 3 months. You know, it's going to take years for those productivity gains to be borne out. So, you know, but between now and then, you know, the US is still staring down the barrel of a recession by the end of the year. And, you know, these companies, whilst there's a perception that they're bulletproof, that they're not. And I think, you know, investors have short memories. And this is a key point, and I know we've got slides about this coming up in the webinar, but, you know, a key point is, you know, investors have got short memories, and it was only in October that the S&P 500 was at 3,500, and the bond rate, the 10-year bond rate, was at 4.2. So those rising bond rates are a real concern and a worry, and at some point, you know, we're going to see that inverse negative correlation between higher bond yields and lower stock prices reassert, I think, with devastating force in those really expensive high PE stocks.
Yeah, well, this is something to look out for as an investor, because these bonds, the bond market always gets it right and gets their way, and stock market usually follows. But your point to October lows, and we can point that out here. You can see you know, even the 10-year bonds last year, around that time, around October, were at a low point. And if you actually go back to NVIDIA as one example, you can see in October, NVIDIA was just about $120 a share. Now it's 300. So there has been a massive jump in these tech stocks. But talk about, Angus, 10-year bond yields, yeah, they're certainly starting to rise. And the 2-year bond yields as well has broken above its recent resistance. What is the bond market really telling us? Because if the debt deal gets done before the deadline is 1st of June, what are you expecting the bond market to, how would that react?
Well, I think the bond market's going to react negatively because the first thing the US Treasury, if the debt ceiling is raised, the first thing the Treasury Department are going to do is go and replenish the coffers. And to do that, they're going to go out and sell probably around $1 trillion of new bond issuance. So not only does that tighten financial conditions quite quickly, and we've already got M2 money supply plummeting, but the supply of paper, the sheer weight of that offering, you know, is probably going to mean that that buyers of those bonds will probably want a higher yield. So I think interest rates are going up. And, you know, if we listen to CEOs like JP Morgan, CEO like Jamie Dimon, who's saying that rates are going to go to 6 to 7% because there's a credit crunch approaching, where banks are just going to be reluctant to lend. So the cost of money is going to get bid up. You know, this is all bad news for the bond market. And we have not seen a reaction yet in those, in the stock market, in the US stock market. It's the fact that the bond rates are rising. So I just keep looking at that every day, and I just think, well, you know, how long is it going to be before, you know, before there's a reaction? Because, you know, rising interest rates are not great for tech stocks and growth stocks, and they're not good for the stock market. So, you know, I do think we're in for a volatile period in the next few months.
Yep, absolutely. That's a good point. In fact, if you look at the correlation, and this is something we certainly, when we do our research at Fat Profits, we look at a lot of these factors, but the bond relationship between the bond market versus, say, for example, NASDAQ or the S&P 500, and this chart shows you the orange line, which is the 10-year bonds. That's not the bond yield, by the way, that's 10-year bond rate. And the candlestick pattern, that's the NASDAQ. And you notice that they usually have a correlation. So they both pretty much go up and down in tandem. But recently, you will notice in the last month or two, the NASDAQ is broken up to the upside, and the 10-year bond is actually going backwards, which means the bond yields are rising. And that usually doesn't happen. So in this case, as Angus rightly pointed out, you will see at some point in time, something's going to have to change. Either the bonds start to go up or the NASDAQ comes down, one or the other. But at this point in time, if the debt deal gets done, what I'm hearing from you, Angus, looks like the bond yields will continue to go higher, which is going to be negative for the markets.
Yeah, exactly. I mean, you know, if you look at the jaws on this chart, the gap that's opened, as you say, Rog, between those falling bond prices and the NASDAQ, which has just popped, you know, it's kind of, it almost looks like a, you know, I could draw the analogy that it's, you know, like a shark coming in to take a bite. It's quite alarming. And, you know, there is going to be a reaction because, you know, history shows us that these two move in tandem. And sure, you know, stocks, equities are always going to be much better than the bond market in terms of inflation. But the question, I guess, you know, probably a lot of people really want to know the answer to, and I think this is the, you know, this is the question I've got. You know, are these big tech, mega cap tech stocks really that good? Are they really that good? And I think the answer to that question is no. You know, they you know, they will feel the bite of the economic slowdown just as most stocks will, and they're now priced at a level where, you know, they're priced at a level where they're priced to perfection. Yet risks are mounting on a number of fronts.
Yes, good point there, Angus. So certainly, the other thing to look at is corporate earnings. We know that Q1 earnings are pretty much done and dusted. Most companies have reported their earnings, and we can share with you that Q1, as you can see on the chart, we've highlighted that Q1 earnings were negative, yes, but not as bad as expected. So they were down about 2.5% versus the expectation of 6.5%. But the one thing which I know Angus has talked about, and plenty of other analysts also have been referring to, is the earnings recession in the US, and that simply means 2 negative quarters of earnings. Now, if you look at the fourth quarter and the first quarter, we have seen 2 negative quarters, so technically it is an earnings recession, but it's all about the future, Angus. The second quarter earnings, the expectation now is certainly that will be a lot lower. In fact, you're looking at 7.5% drop. That's the market consensus. And then third quarter pretty flat, and then rising earnings from that point onwards. Your thoughts?
Look, I think look, we know that companies window dress their earnings. They lower the bar, then they come in with a beat because it makes everyone sort of feel better. But the fact of the matter is, we came into the first quarter earnings results with a very low bar of expectation, which is, you know, pretty standard and typical. And there was a decent beat with some companies, but many companies actually did miss. And, you know, we only have to look at the Russell 2000 small mid-cap index, which hasn't really done that well this year. And the narrowness of the rally this year, companies which have beaten, you know, the tech stocks, etc. But I think, you know, the corporate environment is going to get tougher. You know, we've had a record pace of interest rate hikes. We've got a Fed that's likely to pause next month, but that doesn't mean to say they're going to be cutting by the end of the year, as the bond market believes and the stock market wants to believe. And, you know, I think economic conditions, financial conditions are tightening, business conditions are getting harder. And we've still got, you know, cost pressures coming through. I think we're in for margin squeeze towards the end of the year. And I think, you know, consensus earning expectations looking out over the next 6 to 12 months are just way too optimistic.
Yes. Okay. And the S&P 500, yeah, just looking at historical PE ratios, just based off valuations, the 25-year average is 16.8, which is the dotted line in the middle. You can see then obviously since 2000 crash, those earnings, which were very, very high, 24 times, they've come down to the 2009 crash, down to under 10. And from that point onwards, they've been rising. But at the moment, we're sort of 18 times earnings. And as Angus has pointed out many times, their expectation is these earnings are a bit high. So we'll certainly be keen to buy when the earnings roll over a little bit further and the valuations are a bit better. Moving on to a couple more things. You look at recently, we've seen the debt balance in US has gone up to a very high level. This particular chart really shows the housing debt as well as the non-housing debt, which is now up to $17 trillion. And you'll also notice that, and here's a slightly better reflection of the non-housing debt, which is rising and rising. And of course, with rising rates. The other thing to look at is consumers' credit card debts. They've also gone up, and you know what's going on with interest rates. They are at record levels at the moment. So you see the credit card balance in the US economy is now just shy of $6,000 per person. And this is now getting close to the previous high back in 2001. So that's something to keep an eye on. How does that compare to Australia? Well, Australia is not too bad. Yes, it's rising here as well, but still reasonably manageable. An average balance per person here is $2,991. So just about half of the US consumer. So still manageable, but not something we want to see going much higher than this. Now let's talk about the rates. We've had a couple of questions about interest rates from a couple of members just now. Now, if you look at this chart, you'll see obviously the Federal Reserve has raised rates rapidly over the last 15 months. And now the big question is, do they go again one more time? And Angus, you said rightly earlier, Jamie Dimon, who's the CEO of JP Morgan, the biggest bank in US, recently came out and said that he expects, and people should be prepared for 6 or 7% rates. Now, not sure about the 6 or 7%, but nonetheless, the Federal Reserve have got a few things to sort out. What are your thoughts on rate hikes? There is a, the meetings minutes came out yesterday as well. What are your thoughts?
Well, the Fed may not raise rates to 6 or 7%, but in terms of bank loans and where interest rates are set on mortgages, and banks determine that, I think he's right. I think that's where they're going. I think we've had a shock to the US banking system. We've had money flowing out of those regional banks in terms of their deposits into money market funds. And we've seen some failures, some high profile failures. It's costing a lot more for banks to attract deposits. It's harder. So yes, look, there's a credit crunch coming, and they're going to be reluctant to roll over and renew loans and grant new loans in the current environment, and that's going to translate to a credit crunch, and I think the cost of money is going up. So that is another brake that's going to be exerted on the US economy.
Yes, and look, the big question now, really, everyone's really looking at whether there is going to be a recession or not. And this is another example of what the fund managers are really doing. And this is a survey again from Bank of America. Majority are actually expecting a soft landing in the US in the next 12 months. And that simply means no recession, but a slowdown, but they're avoiding a recession. There are some in the hard landing camp, it's about 25%, who are expecting a recession and unemployment to rise, and of course the economy to slow down. Angus, what camp are you in?
I think the US is heading for a hard landing. And, we've spoken about a credit crunch and what that means. I don't think I've ever seen a credit crunch without a recession. Certainly not in my lifetime. Credit crunches go hand in hand, typically with recessions. And I think that the monetary policy has a lag. It has lags. And, I think that the Federal Reserve, they're going to keep rates high. They might pause, they might skip a rate hike at the next meeting, but they're going to keep rates high until that inflation is squeezed out of the economy. Now, the problem with the inflation rate is it's permeated within the economy. It's become systemic, and you know, it's manifesting itself in lots of things like services and wage growth, which is proving to be really sticky. So the problem and the paradox therein lies that, you know, how do you bring the inflation rate down with the unemployment rate at 3.5, 3.4%? You know, the unemployment rate's got to go up. So I'm in the hard landing camp. I agree with Stanley Druckenmiller that the US unemployment's going to have a 5 in front of it when this recession hits and bottoms, and I think interest rates are going to go higher. So yeah, definitely in the hard landing camp.
Okay. Well, that's a contrarian call against some of the big crowd that's piling into the soft landing camp. So time will tell. If our call is right, well, that cash that we're sitting on will certainly come in handy, and we encourage members to hold on to their cash until the later part of this year. Moving on to the US dollar, I think there's a few questions come through on the greenback because it has made a rebound. And as you said earlier, if the debt deal is done, then most likely the bond yields will go higher. Would you expect the US dollar to go higher in the short term if the deal was done?
Yes, Roger, I do. I think the US dollar can rebound to at least the 105.50 level on the dollar index chart. And what's really happening and driving this is that we've got US interest rates reasserting to the top side. We've got the 2-year bond yield well through 4% now, and we've got the you know, close to 4.5 now, not too far off the October high, which is around 5. And of course, we've got the 10-year bond yield approaching 4. You know, it's at 3.75 or thereabouts. And of course, the peak there in October last year was about 4.3. So yes, these rising interest rate differentials are going to push the US dollar higher. But let's not forget that you know, there's a dark lining to the debt ceiling being lifted, and that of course is debt. You know, the fact that the United States is going again borrowing trillions and trillions of more money, and you know, at some point, you know, that is going to weigh on the greenback. So you know, looking, you know, medium to longer term, I'm still very much bearish, but on the greenback. But near term, the currency looks like it's got more legs on the upside.
Okay, so I guess if the deal gets done, US dollar goes up in the short term, that has an inverse relationship with gold, and gold has come off its recent peak and it's now down to about 1950. How do you see the gold price in the short term? I know long term you expect the gold to be pretty strong. Short term, would you expect it to retest some of these support levels?
Look, I think you know, the stronger dollar is a headwind for a lot of asset classes, and you know, precious metals are not immune. So, for example, you know, we're seeing you know, a range of commodities under pressure with the stronger greenback in the last few weeks. We've seen Asian stock markets take a knock. You know, the CSI 300 and the Hang Seng are all under pressure because of those tightening financial conditions that happen when the US dollar appreciates. And so to answer your question, yes, I think, look, gold could correct lower. We could see it come back to the 200-day moving average. We could see it come back to that trend line support level. And but I don't think this is necessarily a reason to run out and sell all your precious metal equity exposure, because valuations are a lot lower. Most of the precious metal stocks, gold equities, are well down from their highs of a few years ago when gold was last at 2000. And you know, a lot of these companies are generating really good free cash flow. So you know, at the end of the day, that's going to allow them to pay big dividends, I think, and it's probably also going to encourage a lot of M&A within the sector. So, you know, I see this as a correction. We could see the Australian dollar gold price come back and, you know, retest support at the breakout level at that 2,800 level, 2,900. You know, it's not beyond the realms of possibility, but this would just be a correction in my view. And, you know, I don't think you really want to be off the gold trade just because of what the gold price might do in the short term. I mean, the US government could default. I'm not saying it will, but it could default, in which case you'd probably see the gold price up a couple of $100. We're continuing to see central banks buying. You know, there's a lot of catalysts. Inflation's not dead yet. Interest rates are still rising. Bonds are still proving to be a very challenging place for investors to be. So, you know, this is a very good environment for gold, and one that is, I think, at the moment quite different to previous bull markets.
All right. Let's move on to Australia. So we've got plenty of conversation about the US. Let's move on to Australia and New Zealand. We'll talk about both and do a quick comparison for you. First, quick update on Australia. We know that inflation in Australia is still pretty high, still around 7%, and that's not comfortable by any means. People still feel it in everyday life. And you look at our cash rate, yes, it was raised last meeting by 25 basis points, so we're now 3.85%. And if you compare that to New Zealand, who have just raised rates again yesterday by 0.25%, they're up to 5.5%. And if you look at their inflation, they're now at 6.7%. So yes, it's coming down, but very slow. And a point to note is New Zealand was one of the first countries to raise rates last year, and they now have pretty much signaled that they are going to pause from now on and watch the inflation numbers. So Angus, how do you see the comparison between the two countries? Both have still got pretty sticky inflation. One's like New Zealand has got very high cash rates, whereas Australia got a lot to catch up. Do you see an issue here in Australia?
Oh, I think I see an issue for the world. Yeah, as we see from the Reserve Bank of New Zealand, you know, they've taken rates. They've got one of the highest cash rate settings in the OECD, and they've still got an inflation problem. You know, New Zealand still is struggling to bring that inflation rate down. So, you know, it begs the question, what's it going to take for everyone else if New Zealand's struggling? You know, I think the answer to that question is inflation, now that it's out of the bag, it is proving to be very sticky, you know, because of the ultra low unemployment rate. You know, like the 1970s, it's hard to put the fires out, the inflationary fires, and bring down wage expectations, etc. You know, and it gets into a sort of a feedback loop and into a spiral, wage price spiral. And you know, it's going to be quite stubborn. I think we're going to be battling high rates of inflation in New Zealand and Australia and around the world for some time.
Yes, well, it looks pretty sticky at the moment. The unemployment numbers came out last week in Australia, and we know that they've gone up to 3.7%, which is unexpected, I might add. So that's probably something to keep an eye on if the labour market starts to weaken. We also published this in today's Daily Fat Chat. The leading economic index has started to show a bit of strength lately, Angus. That's probably not what they want to see at the Reserve Bank.
No, it's going to frustrate the RBA like anything in terms of you know, trying to bring that inflation down. It's going to be a difficult time, and you know, the fact of the matter is that you know, interest rates are probably going to have to remain high for some time until the economy really slows down and get rid of this inflation. It's a battle. It's a real battle.
It is a real battle. You're right. And the other thing is as well, wages have grown in Australia, and they're now 3.7% higher than a year ago. So on one side, as a consumer, you feel good, but on the other side, inflation is eating away as well. But it's a productivity, which is what's worrying, you know, the Reserve Bank as well. Yes, the wage prices have gone up. You can see that again on this chart. But you know, the real wages are negative because of high inflation, and that's the problem. So on a side note, the labour market is still quite tight because it's very difficult for businesses to find quality labor, and that's where the issue is. And that's just not just in Australia. I think it's just around the world in many developed countries. So that continues to be a sticky point for them. Moving on to finish off with Australia, the ASX at the moment, Angus, is sitting just below 7,200 points. So we're still not too bad. You could argue that the bulls and the bears are pretty much going sideways. Not a bad position. Portfolio is looking okay. How do you feel about the ASX?
Look, I'm cautious near term, Roger. For the reasons that we've been discussing on the webinar, I am cautious. I think the RBA have got a lot more work to do to get that inflation under control, and I think unemployment has got to go up to slow the economy, slow the demand function within the economy, and so I think near term I'm cautious on the ASX 200. Of course, it's worth emphasising once again that our valuation is a lot lower. We're not the FANG stocks. We don't have a multiple of 35 times on our market, but it's not dirt cheap either. And so cautious. And of course, we've had some disappointing data out of China. The reopening recovery hasn't been quite as strong as what all the economists were looking for. And of course, that's now impacting raw materials and commodities. And we've seen, gold, we've seen iron ore break below $100 a tonne this week, which is not good news. We've seen copper prices under pressure. So I think there's quite a few headwinds out there. So cautious at this stage.
Yeah, I think that's the final point for today, is China slowing down. You're right. I think Australia certainly looks up to China for many reasons, being our biggest trading partner. And China is actually slowing down, and you can see that through a lot of stats coming through. And of course, the Chinese market is also reacting accordingly, because market's actually going down as well. But the PMI numbers, you can see that on the charts, they are starting to come down after coming out of lockdowns. You can see retail sales also slowing down as well, and the housing market is still having some issues. So all in all, if China continues to slow down, well, that's a bit of a headwind for Australia, but time will tell. For now, look, our overall position remains the same. Our overall message to clients remains the same, which is hold on to your cash. And if you haven't raised your cash levels to those numbers that we've discussed before, then we encourage you to look at your portfolio, see where you can lighten up, hold on to defensive stocks, and that's our general advice. But I'll take a couple of quick questions here, and then we'll wrap up today. So here's the first question for you, Angus. Hang on, this is from Kev. He's saying, you mentioned last time that you closed out your shorts on the S&P in the US markets, as you saw that there's a technical bullish trend in the index. Are you still of the same view?
Yes, look, I think near term, if there's a resolution on the debt ceiling, the market will go higher. On the back of that, there'll be a relief rally, possibly taking out the 4,200 level. If the 4,200 level is crossed by the S&P 500, I think it's going to trigger a lot of short covering. It's also going to draw a lot of cash in from the sidelines by investors with FOMO, fear of missing out. We're already seeing a bubble-esque event happening with those mega cap technology stocks. And so I could see, in that situation, I could see the index get to 4,400. But of course, at that level, it sets the S&P 500 up for a greater decline later this year, when the disappointment around the economy and the earnings, more importantly, the earnings starts to come through. So yes. I still think we did the right thing by taking the shorts off, with the view that the debt ceiling will get resolved. I still think it'll get resolved, but as we get closer to the 1st of June, when the government runs out of money, the markets are going to get a lot more volatile, and maybe that'll wake the politicians up and snap them out of their snap them out of their stupidity.
All right. Okay, well, that's all we've got time for today. Hopefully you guys enjoyed today's session. We put a lot of information out there for everyone to understand what's moving the markets and where we're likely to go. And that's the key message is position yourself accordingly, have a view on the markets, and then react accordingly. So look, on that note, I'll say goodbye from my side. My name's Roger. Thanks for your company today. We look forward to seeing you again next Thursday. And I'll certainly pass it on to you, Angus. Look, Angus, I'll say on behalf of members, we really appreciate your time every Thursday and all these breakdown of market moving events and how to position your portfolio really helps, I'm sure, members. I certainly get a lot out of that as well. So thank you to you, and I'll pass it on to you for your final words.
Yeah, thanks, Roger. I really enjoy doing these webinars with you as well. I hope the members get a lot of value out of it. Look, we obviously we don't get it right all the time. We don't get it right some of the time, or even most of the time on occasions. But we do give it our best shot. And I just caution everyone out there at the moment to be on the to play defense at the moment, not offense. And you know, I think we've just got to be careful out there with respect to what's happening with some of these mega cap tech stocks, which are, you know, really beginning to look like a like an AI bubble. And on that note, I will say bye for now.
Thank you.